Hey everyone, and welcome to this explainer. Today we are tackling a massive topic, mastering the stock market from scratch. If you've ever looked at a giant wall of financial jargon or a dizzying stock chart and felt completely locked out of the wealth-building engine of the world, you're in the exact right place.
So let's just address the elephant in the room right off the bat. Is the stock market just a giant lottery? A lot of people actually think investing is basically just gambling in a suit. But when you look closely at the mechanics, that couldn't be further from the truth. It's actually a highly systematic tool for wealth creation, if you know the rules.
Here's our roadmap for today. We'll start with a quick welcome to the stock market, move into some essential trading terminology, look at how to actually analyze the market, go over some common beginner mistakes you'll definitely want to avoid, and wrap up with the exact steps to start trading.
All right, let's jump straight into Section 1. Welcome to the stock market, where we're demystifying the financial core. At its core, think of the stock market as a giant centralized marketplace. But instead of buying apples or shoes, investors are buying and selling actual ownership in publicly listed corporations. When you invest, you are literally handing over cash to fund a company's expansion. And in return, you get a real stake in its future growth. And what's really wild is how digital innovation has completely democratized this whole thing. Thanks to modern zero-commission fintech platforms, everyday retail capital, your money and mine, can now step into the ring and compete directly with massive institutional funds. It's a total game changer.
Moving right along to Section 2, essential trading terminology, basically learning the language of investing.
First up, we've got equities, or shares. Simply put, this represents fractional ownership in a firm. Now, it's easy to just see these as digital numbers flashing on a screen, right? But actually, scratch that. You need to think of it more like buying a single brick in a massive corporate factory. You actually own a tiny, literal slice of that real-world company.
Next up is the dividend. This is simply a distribution of a corporation's earnings to its shareholders. Basically, it's how companies reward you just for sticking around. When they make a solid profit, a little piece of that success goes straight into your pocket. Not a bad deal, right?
Then we have volatility, which is the degree of variation in trading prices over time. It's essentially a measure of how wildly prices swing up and down. Grasping this is absolutely crucial for managing your own psychology, because the market isn't static. It's always breathing, adjusting, and, being volatile. Now, the overarching market sentiment dictates those price trends, and that leads us to two distinct environments. First, a bull market. This happens when prices are broadly rising, usually driven by a ton of investor optimism. On the flip side, we have a bear market. This is a market downfall where prices drop by 20% or more from their recent highs. Recognizing which of these two environments you're actually in changes pretty much everything about your strategy.
Okay, let's dive into Section 3. Analyzing the market. Essentially, how to choose what to actually buy.
So, to decide what to put your money into, traders generally rely on two distinct research methods. First up is fundamental analysis. This is all about getting into the weeds of a company's actual financial health. You're inspecting balance sheets, looking at revenue growth, macro trends, and checking the quality of their management to find the company's true intrinsic value. On the other side of the coin is technical analysis. This focuses purely on a stock's mathematical price movements. Technical traders look at price patterns, support and resistance lines, trend lines, and statistical indicators on a graph to figure out the exact perfect time to enter a trade. To put it simply, fundamental analysis tells you what to buy, while technical analysis tells you when to buy it.
All right, moving on to Section 4, common beginner mistakes, or as I like to call it, avoiding the traps of fear and greed.
Listen closely here, because the absolute golden rule of risk management boils down to one simple number: 1 to 2%. A disciplined trader will never, ever risk more than 1 to 2% of their total account on a single deal. Adhering strictly to this cap is pretty much the only way you're going to survive catastrophic drawdowns when trades inevitably go south. And believe me, they will go south sometimes.
Alongside ignoring that risk management rule, there are a few other massive pitfalls that frequently wipe out beginners. Lacking a concrete plan is a huge one. Treating the market like a casino just based on some random YouTube tips. Please don't do that. Then there's overleveraging. Sure, it magnifies your gains, but it aggressively magnifies your losses, making it a fast-track shortcut to insolvency. And finally, chasing the hype. If you're buying purely because a stock is skyrocketing in the news, you are more than likely buying at the absolute top, literally right before a very painful reversal.
Okay, let's get into our final section, Section 5, Steps to Start Trading, where we're building your foundation.
When you actually look at how successful traders start out, a really clear timeline emerges. Day 1, your education begins with classic books like The Intelligent Investor. Fast forward a few days, and you can generally grasp the basic operational mechanics and definitions. But here is the reality check. To achieve consistently profitable professional status, that typically takes 6 to 12 months of active, highly disciplined practice. The basic rules are super quick to learn, but true mastery? That takes patience, for sure.
To actually reach that level of mastery, you really need to follow a strict order of operations. Step 1, education first. Read those books, utilize free online courses, and soak it all in. Step 2, paper trading. Listen, before you invest a single dime of real money, you absolutely must test your strategies in a virtual demo account. This lets you understand market dynamics with zero financial risk. And Step 3, choose a reliable broker. You've got to make sure the firm complies with strict regulatory standards, places like CISEC or the FCA, to guarantee your funds are actually safe. Now, when you do reach the stage of choosing that reliable broker, you'll find the market is just flooded with options, all designed for different strategies. Some platforms, like XTB, focus heavily on zero-commission trading, while others, like IC Markets or Fusion, prioritize ultra-low raw spreads. You're also going to see variations in the platforms they support, from MT4 and MT5 to proprietary systems and TradingView. The main takeaway here isn't to just blindly pick one off a list, it's to impartially review the data and select the specific broker that perfectly aligns with your educational level, your strategy, and your regulatory needs. Ultimately, everything we've unpacked today boils down to one incredibly powerful truth. Success in investing is about time in the market, not timing the market. The stock market is not a giant lottery meant for perfectly timed, lucky bets. It is a robust system for long-term consistency. Start small, stay strictly disciplined, and just let your education compound over time. And with that, I want to leave you with this final, provocative thought. What will your first step be? You've got the roadmap now, you know the vocabulary, and you know exactly which pitfalls to avoid. The challenge is now yours to take action and dive even deeper into your financial education. Thanks so much for joining me for this explainer today, and I'll catch you in the next one.